Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Different investors have different ways of classifying businesses. Now, one of my favorite classifications is inspired by Warren Buffett, who likes to classify businesses as great, good, and gruesome. Let me repeat that. As per Buffett, businesses come in three categories mostly, and these are great businesses, good businesses, and gruesome businesses. Now, given here are three businesses that can qualify as great businesses. These are Page Industries, PI Industries, and Pidilite Limited. I have deliberately chosen businesses starting with the letter P so that I am not accused of cherry picking them to suit my narrative. One look at the key financials and you would know why they can all be considered as great businesses. Look at the last two rows, that is the average ROE and the average ROCE. The high return on equity and return on capital employed is what makes a great business. Great businesses are highly capital efficient and have a moat or a competitive advantage that allows them to earn more per rupee of capital employed in the business as compared to other businesses. It is like opening a savings account in a bank where you earn a minimum of 25% to 30% interest on your fixed deposit, and that too year after year on a consistent basis. As you can see, there are also zero debt companies with little to no borrowings. Therefore, consistently high ROEs and strong balance sheets are the necessary conditions for a business to qualify as great, and all the three businesses fulfill these criteria. Up next are good businesses. I have again chosen them such that they all start with the same letter, that is the letter A. Ambika Cotton, Angel One, and Apar Industries can be classified as good businesses because their ROEs and ROCs are a notch below great businesses. These companies are not as capital efficient as great businesses but are decent businesses nevertheless. They are mostly profit making, have strong balance sheets, and also have consistency in their earnings power. As can be seen, all the three companies have either stable or growing EPS. However, as I have said, the consistency with which they earn returns on the capital employed matters a lot, and all the three businesses have done a decent job on this parameter. Next on the list are the gruesome businesses. As you can see, these companies are characterized by loss-making operations, high debt to equity, and very poor return ratios. All the three stocks have exhibited these qualities in spades for the 7-year period between FY15 and FY21. I am sure you are surprised as to why I have classified Suzlon as a gruesome business, because both the business as well as the stock price has done so well recently. Well, I went simply by the past performance between FY15 and FY21, and the company did really struggle during this period. Its profitability was all over the place during this period, and it also had a lot of balance sheet challenges to address. So is the case with the other two companies, that is Swan Energy and Shoppers Stop. These companies have also struggled during the same period and can be correctly called as gruesome businesses. To summarize so far, great businesses have strong competitive advantages and earn consistently higher ROEs and ROCEs. Good businesses are not as good as great businesses in capital efficiency but are decent businesses nevertheless. And lastly, the gruesome businesses, where not only the core business is weak and loss-making, the balance sheet is also loaded with a lot of debt. To be honest, if you invest in gruesome businesses, there is a strong chance you will destroy wealth instead of making it. Now here's a very important chart, the share price returns of each of these groups for the 2-year period between December 2021 and December 23. Now this is surprising. Every rupees 100 invested equally between the three businesses of each group has become only rupees 107 for the three great businesses. On the other hand, an investment of rupees 100 in the good group of companies would have almost multiplied your money by 4 times during the same period. This group has turned every rupees 100 into an impressive rupees 386. The biggest surprise, however, is the gruesome group. the group that we've called the wealth destroying group. An equal allocation amongst all the three companies in this group would have multiplied invested money by almost 3.2 times. So the Gruesome group has not destroyed wealth. Instead, it has multiplied wealth by more than 3 times between December 21 and December 23. Now, what explains this divergence? Shouldn't the great group have done the best, followed by good? Why has the Gruesome group multiplied wealth by 3 times instead of destroying it? Well, it does not matter that the Gruesome group has multiplied wealth by 3 times. You see, in investing, there is investment and there is speculation. Now, investment is an operation which, upon thorough analysis, promises safety of principal and adequate return. Gruesome businesses that we saw were loss-making and had stretched balance sheets. There is no way they could have qualified as investment based upon their historical performance. Of course, they may show improvement in the future. However, a bright future alone is not necessary for a stock to qualify as an investment. A business needs to be sound both in terms of its past as well as future performance. Absent any of these criteria, and the stock does not qualify to be an investment. Well, the 3 Gruesome businesses we saw had a poor past and hence they would be termed as speculative. One cannot make them a core part of one's portfolio. Therefore, even though they gave 3 times or 3x returns as a group, they continued to be speculative stocks. Now, coming to the great and the good businesses, this table will show one big reason why they have performed the way they did. As you can see, all the 3 great businesses were trading at very high PE multiples back in December 21. While Page and Pidilite were trading at almost 100x PE multiple, PI Industries was not cheap either at almost 60x multiple. Thus, these stocks were banking heavily on earnings growth for their share prices to go up significantly. When the earnings growth did not come in as high as expected, the stock price remained almost stagnant and the group underperformed. The good businesses, on the other hand, were trading at reasonable valuations. All of them were under 20 PE multiple, which is quite decent in my view. Hence, when high earnings growth came in, the share price of these companies took off and the group went up by almost 4 times between December 21 and December 23. So the takeaway is clear. Buying good businesses at reasonable PE multiples can give you much better results over buying great businesses at very high PE multiples, especially if the time horizon is just 2 to 3 years. Over a longer time horizon, you may still get away by paying slightly higher PE multiples for a great business. But over a shorter horizon, a very high PE multiple for even a great business can prove to be a wealth-destroying decision. Okay, now what do you think about the following business? Well, this is no great business, to be honest. Not only has it made losses in the past, but the average ROE and the ROCE is also nothing to write home about. It is not a great business by any stretch of imagination, not based on its past performance at least. Is it a good business? Well, I have my doubts even on this one. A great or a good business must be profitable at least and must have an average ROE and ROCE of at least more than 15%. However, this stock fails on both the counts. Hence, if you go strictly by the definition, this business falls into the category of a gruesome business. In other words, if one invests in this stock, he is not investing in my view but speculating. Also, check out the P ratio of the company. It is more than 1000 times. Yes, you heard that right. The stock is trading at a whopping P multiple of more than 1000x. I believe that forget gruesome business, this is a very high P multiple to be paid even to a great business. Hence, if you are thinking of investing in this stock or have already invested, this session should act as a warning sign. Not that making money on this stock over the next 2 to 3 years is going to be impossible. However, the risk reward ratio is certainly not in favor of the investor. Now, let me reveal the name of the stock to you. Well, it is none other than FSN E-commerce Ventures, better known as Nykaa. Yes, based on my framework, Nykaa qualifies as a gruesome business. Now, this does not mean that the company cannot turn around in the future. It certainly can, and at least the market seems to be thinking so. Otherwise, it would not have assigned it a P multiple of more than 1,000 times. As for me, I'd rather focus on a business that's already great or good instead of the one that is expected to make the difficult transition from gruesome to good or even great. Remember, even Mamaearth was touted to be the next big thing. However, we all know what happened to the stock. The sky-high expectations were not met and the stock price came crashing down. A similar danger lies ahead for a lot of gruesome businesses where the valuations also are sky-high. So please be careful and invest sensibly. That's all from me today. I'll see you again in the next session. Goodbye and happy investing.